Morning, welcome. My name's Jamie Evans. I'm a partner here at Orrick's Capital Markets Group focused on technology. I'm here with my friends Zaheed, Kajani, and Scuorzo from Evercore. We're going to give you a brief update on the state of the capital markets here as we head into the early part of 2024.
Jamie, thank you for giving us the chance to share our thoughts today. Again, for the audience, Zaheed Kajani. I'm a Senior Managing Director at Evercore. I cover the technology sector and have been covering the sector for over 2 decades now.
Jamie, thanks for having us. Scuorzo. I'm also a Senior Managing Director at Evercore, and I run our technology equity capital markets effort for us. And I've been in the industry for over 25 years.
Great. Welcome, guys. It's good to have you here. And obviously, we go way back, so it's good to see you and look forward to catching up this morning. And so let's start with maybe talking about the state of the capital markets generally before we jump into tech specifically. But would love to hear from you guys what you're seeing generally here as we go into the early part of 2024 and what you're expecting to see as we move through the balance of the year, maybe.
Yeah. I'd say that investors right now have an intense focus on the macroeconomic backdrop. It's very complicated right now. We've got a lot of interconnected and countervailing forces that are making forecasting very difficult. And most are getting it wrong. If you rewind the clock and go back a year from now, it was the near 100% consensus that the US was going into recession. Here we are today. There seems to be no recession imminent, and in fact, the economy seems to be on pretty strong footing. If we look at rates and what the Fed's going to do, go back 30 days, the markets are pricing in an 85% probability that the Feds were going to cut rates in March. Today, it's nearly zero, and rate cut expectations are now pushed out to June, as the last mile of inflation seems to be stickier than hoped. That said, the market continues to perform based on the fact that the economy is still strong. Employment remains, a driver of that. Corporate earnings are strong. If you look at, we're through 80% of S&P 500 earnings so far this year, and we beat on average top line by 1% and earnings by 3%. And therefore, the markets continue to make all-time highs. Volatility is at multi-year lows. And this is even in the face of the decoupling of the Magnificent Seven. And so our perspective is, the business fundamentals will continue to drive the markets, even as investors try to ascertain the direction of the Fed and the macro economy. But for now, fundamentals are winning out. And what's interesting, though, and we'll talk more about this as we go through, despite the strong market environment, we have yet to see a real unfreezing of the IPO market.
Right. Yeah, absolutely. So one thing, obviously, I think we're all thinking about is that we have a somewhat tumultuous election cycle coming up here, and we're sort of already into it, and it's going to really kick off in earnest here in the next month or so. How are you guys thinking about that? Obviously, volatility in a market is always challenging, and as we think about what the balance or the back half of 2024 is going to look like, how are you guys thinking about that from a macro perspective?
Yeah, unfortunately, our view is that volatility will pick up in the back half of 2024, and largely due to the election. If you look at history, and I'm not sure history is going to be a great guide given the election cycle we're about to go into, but when you have the state of government that we're currently in, which is defined by it being tight and divided, and tight means that there's a narrow differential between Republicans and Democrats in both the House and the Senate, and divided where we have split leadership of the House and Senate. Volatility in those election years is typically 2x what we see in election years where we have a unified government, and that's decisively unified. So our expectation is that volatility will pick up. The things that the market's going to focus on in reaction to the election, we believe, are fourfold. The first is around tariffs. One candidate, and Donald Trump, is advocating for 10% tariffs on imports and larger potential tariffs on imports from China. That goes to the second major issue, which is the status of U.S.-China relations. The third is around the Inflation Reduction Act and what becomes of that, in the next, presidential whoever is elected. And then lastly is around taxes as the Trump tax cuts sunset in a couple of years from now.
Great. And before we jump into tech specifically, anything else we should be, especially attuned to as we look to the balance of the year, whether it be, beyond the election cycle, whether it be geopolitical, et cetera, things like that?
Yeah, it's our view that geopolitical environment is actually poses a bigger risk for the market than the elections. As we all know, we're 2 years into the conflict in Ukraine. There's significant risk that the war in the Middle East broadens out, and tensions remain high in Asia, particularly China and Taiwan. So those are things that are very much on the radar of us as well as investors. And as we sort of probability weight risk for the overall market, we believe those are potentially higher than the election outcome.
So Zaheed, anything we should be especially attuned to as we go into our 2024 earnings cycle?
Yeah, look, I think that if you've seen what we went through in 22 and 23 was we went from a growth at all costs to a profitable growth environment. And what you saw was companies revisit their unit economics, you rationalize their resources. Unfortunately, that transition into significant amount of layoffs, as you've seen throughout industries, especially in the technology sector. But what happened is, as the companies have started to grow again, they've become very profitable. So you saw Amazon post, I think, its second best margins that it's ever has in its history in Q4. And so it just highlights that as these companies have rationalized cost, that the earnings potential is higher, and you see that in the equity markets at all-time highs, which we think will continue into next year. The other thing is, as these companies think about other ways of creating shareholder value, they're more differentiated in their approach. So you saw Meta, think about share buyback, which they've never done historically, and dividends. And so it just shows you that it's it's evolving how they're trying to create shareholder value, and we think that will continue to play out as we go into 24. Unfortunately, those companies that have not been able to rationalize cost and are still not profitable, they continue to be challenged. You see that in the private market, and you see that in the public markets as well, with their with the valuations where they are.
Yeah, I actually have a follow-up question for you on that, Zaheed, which is, I've even seen, I think even this morning, continued stories about that rationalizing on the cost side of things, and frankly, that companies are going to continue to do that in many ways, including prominent companies as we go through the balance of the year, and in an incremental way. In fact, do you expect to sort of see that broadly, or is that certainly in my world on the tech side, it really is something where I continue to see, even in the face of enormous profitability, you see companies continue to focus on, do we have the right people in the right places?
Yeah, look, I think there's a allocation of capital discussion going on within these organizations, and since you mentioned tech, some of the larger tech companies had a lot of what I'd call projects that they were evaluating, and I think as they're trying to rationalize, they're evaluating each one of those and the opportunity there, and is this a place that they should be allocating capital? And as they're revisiting that, there may be layoffs in one part of the organization and hiring another part of the organization. And the other thing that we didn't talk about yet, but is obviously it has implications, is AI,
right?
And generative AI, and that may be causing changes in employment in one part of the organization and trying to hire additional resources in another part of the organization. So we expect that to continue. The other thing is, I think some of these organizations had hired so many people over the last several years that they have pockets of areas where they could continue to rationalize. And to be honest, I think they haven't done it and have kept it in their back pocket for whenever earnings are a little bit on the lighter side, they can use that as an additional tool over the next 12 to 18 months.
All right, guys. Well, let's turn and talk specifically about tech a little bit. Obviously, we're all focused on tech, the three of us, and would love to hear from both of you on what you're thinking about in terms of key trends that we're going to see on the tech side this year.
Great, I'll start. Look, the key secular theme that's in the market right now is AI. AI is huge, and it affects every segment of tech, and in fact, is going to impact every segment of the economy broadly. As we think about tech, we sort of think about AI into two buckets. The first is enablers, and the second is adopters and adapters. So enablers is the part of the market that has gotten the most focus in the public side in the last, call it, 12 months. Stocks like NVIDIA, more recently stocks like ARM. These are the picks and shovels that provide the performance increases that are required for the AI applications to function in the market. And so those are necessary for the development and deployment of AI applications. So AI is going to drive a lot. For already public companies and private companies, if you're not an enabler, the discussion around how are you going to adopt and adapt AI is going to be incredibly important to ensure, one, that you're leveraging the tools that are available to help grow your business, number one, two, cut costs, and three, ensure that you're future-proofed against other companies that are out there that are innovating with AI. So that's the broad overall theme. When we think about sectors of technology and how that's going to impact 24 and beyond, again, we expect to see significant increased focus and demand for anything in semiconductors and networking. Again, these are the picks and shovels, the AI enablers. Software is going to continue to be hugely thematic. Again, folks that are providing tools and applications that put AI into the hands of end users and corporates and help corporates harness the data so that they can create AI solutions. So software is going to be very important from that perspective. But when you move beyond the AI theme, cybersecurity continues to be top of mind and top of corporate budgets, especially in a geopolitical environment that certainly has increased threats from around the globe. And companies need to continue to make sure that their cyber is best of breed to ensure protection of the
Can
firm.
I ask a quick follow-up question, John, which is, I'm interested, given the prominence of AI and frankly cyber as well, and the upfront investments that are going to be involved in really building that, are we going to see winners and losers in this year as it relates to those things? Or are the enablers, if you will, going to be the ones that are going to be the first where we'll see the success or failure of those investments? And then those that are sort of not the enablers, but the utilizers, if you will start to see that later on.
Yeah, 100% agree. So the enablers are the ones that are currently generating revenue directly associated to AI as they help to basically help the hyperscalers improve the performance of their data centers and compute capabilities. That's generating revenue today. As it relates to adopters and adapters, that's going to take time to figure out who the winners are, as AI is still pretty nascent, and what's ultimately going to emerge as sort of the killer app, for lack of a better term, is to be seen. But we expect innovation and proliferation of successful companies to increase over the next few years as this market sorts itself out.
Yeah, and Jamie, if you actually, history is our guide. If you saw it in 99, 2000, in that cycle, the winners were Cisco, Intel, Microsoft Windows, Dell, those people enabling the internet environment to grow. Eventually you had the Amazons be successful and the bookings and price lines, et cetera. But initially it was those enabling the ecosystem with compute power and networking, which was Cisco, obviously, and Intel with the PC. So we'd expect that to play out here as well. Other trends that I think are important are, first, the regulatory backdrop. I think is really impacting a lot of discussions in the markets today. You saw the Figma deal get terminated. You saw the iRobot deal for Amazon get terminated. You saw Giphy have to, which was a very small company for Facebook at the time, but Meta. It was a $300 million acquisition that ultimately they had to divest due to regulatory reasons. And so it just highlights that the regulatory environment is certainly impacting the company's perspectives on how they proceed in the current markets. The other couple trends I would say is monetizing through online advertising across the board. So, you saw Netflix, who was a subscription business, ultimately give in to advertising as a way to monetize. Amazon, if you look, a significant amount of its profit comes through online advertising, not through e-commerce. In fact, if you look at the data, almost all of its profit comes from either AWS or online advertising, not their actual e-commerce business. Now, obviously, you couldn't have that advertising business if you didn't have that e-commerce business, but it just highlights the monetization of advertising as important across all companies. And I think the last point I'd like to make is non-tech looking at technology companies. It's an area of focus. You've seen a recent transaction with Walmart making an acquisition in the technology sector. We think that will continue to happen, where you see non-tech companies looking more and more as technology companies as acquisition opportunities or investment opportunities, which we think will be another major trend over the next several years.
Great. And I think that leads pretty naturally into what my next set of questions were going to be, which is, obviously, you and I and John are all transactionally focused. So just curious about how you think about these macro trends affecting kind of the IPO market as well as the M&A market. Thoughts there?
Yeah, great.
Start with the IPO first.
So from the IPO market perspective, clearly we have yet to unfreeze the market from 2021. We largely believe that's more of a supply problem than a demand problem. I think the companies that went public in September proved that there is significant amount of demand, for IPOs, just based on how those deals were received at levels of oversubscription and how they priced versus the range. But the supply side of the equation remains challenged. And that's largely a hangover from the 2020 and 2021 private capital raising environment, where companies were able to raise a significant amount of capital at very lofty valuations. And those valuations are probably for many still hard to achieve in the market today. They still sit on a fair amount of the cash they raised back in 21, and therefore reluctant to go into the IPO market and potentially price at a down round to the last round. So there's certainly some supply-demand imbalance, and there's a bid-ask spread between sort of where private companies in the technology sector view their value versus where the public markets are willing to pay. That said, that bid-ask spread is narrowing, and we do expect a handful of companies to begin to test the market here in Q1. We expect it to be 2, maybe 3 technology companies that go first. And to the extent that those transactions are well received and trade well in the aftermarket, our expectation is that we see a second wave of fast followers go into the IPO market shortly after those are proven successful. If we think about where we believe the 24 tech IPO market can get from a volume perspective, if you go back over history, the tech IPO market, on average, 40 companies go public, raising about $20 billion. This year, we're hopeful we can get to about half of that, about 20 tech IPOs, because the reality is the majority of companies are going to try to get public before July, given a prior discussion around the expectation for volatility in the second half of this year due to the election. That's not to say that some companies won't be able to go public in September or even after the election, but right now, plan A, as companies are going to their boards of directors, and if they want to get public in 2024, the mandate is to try to get out before July.
Look, Jamie, when we think about the M&A market, if you look at 23 to 22, it was down about 5%, not as significant as one would have imagined. That was really mostly driven by energy companies in the financial sector, with all the banks having combinations, et cetera, with all the challenging in the regional bank environment. If you actually look at TMT, or Technology, Media, and Telecom, it was down about 50%, which was down another 50% from 21. So it's been down quite a lot over the last 2 years. We've seen some early indications of that pickup in M&A starting toward the end of last year, October, November. We started to see a pickup in activity. We do expect activity to pick up quite meaningfully over the next year or two and kind of revert back to the mean for a number of reasons. One is the liquidity options are somewhat limited. The IPO market has been challenged for a while. Raising capital in the private markets have been tough. And so we expect more M&A because of that, is a more likely option. Two is, sponsors who are, a driver of big portion of M&A activity, they haven't had liquidity events for a while. And if you look at their LPs, they're really looking for some form of liquidity. And so if the IPO market isn't as robust, or valuations have come down and they're trying to navigate that, the M&A market is an obvious place to exit, and especially as we're starting to see strategics be more aggressive with their stocks near all-time highs, with their strong balance sheets, with their more efficiency in the unit economics that we spoke about earlier, in rationalization of their organizations. They're now willing to be more aggressive. You know, when we had conversations with a number of the strategics, I would say in mid-23 or earlier, they saw a lot of these stocks at all-time lows, and so you would think they would take advantage of these acquisitions opportunities. But their perspective was, look, we just told the street we're going to be cutting costs, we're going to be rationalizing, we're going to be more efficient. I can't go back to the street right now and say I want to do this aggressive M&A. It's just, even though I know I'll have to pay a higher price down the line as these stocks kind of come back up, I have to wait until I've got my organization in the right place before I can take that step, get my board comfortable with that, as well as get the street comfortable with this strategy. And that's what we think we're going to start to see. And you know, we're seeing it within Evercore already with the level of activity within our organization, and in the key KPIs that we look at, we see that across the street as well. And so we feel very good about what we're expecting, you know, over the next kind of 1 to 2 years on the M&A front.
I've got a follow-up question for you guys on that one, which is one of the trends that you mentioned before was the regulatory landscape and the impact of that on activity, if you will, or the regulatory overhang sometimes. I might even think of it as we go into an election cycle, and I think we have two pretty significantly opposed philosophies as it relates to regulation and the value of regulation from a market's perspective. Do you expect coming out of an election cycle, so say we get to November and we have an answer finally on that outcome, do you anticipate one answer or the other having, you know, better or worse impact on not really the 24 obviously, but going into 25? Would you anticipate, is that a binary outcome, or is that really more nuanced than that?
Yeah, look, so I'm not a policy expert for DC. We have people like that within Evercore, but look, from my perspective and my own view is, I think it's very nuanced. I think the large cap or the mega cap, the Magnificent Seven as we're calling them now, I think there's just a lot of pushback on them being more aggressive in any you know, either party or either regulatory regime. So I think they're going to remain challenged in this environment, no matter who wins. Although I think there's some nuances of which areas of focus that they have more limitations on than others. You know, I think AI is a big area that people are still trying to understand and how that's going to get regulated or not. You know, we obviously went through some of that in crypto and kind of different perspectives there. And so I think there's more nuance to that. And I'm not sure, at least my read of it, there's a major difference between the potential two candidates. But there may be more data we'll collect over this election cycle in the next 6 months to get a more refined perspective.
So we saw a handful of IPOs come out at the end of last year. Just interested in your guys' perspective on the outcome of those and how they might forecast what we'd expect to see through the balance of this year.
Yeah, great question. Obviously, there was a lot of anticipation and hope for the IPOs that tested the market in September. The reality was those transactions from a subscription perspective were very well received, but from an aftermarket trading perspective, were highly disappointing. Let's just start. The companies that went public, they were the right companies to try to reopen the market. They were good businesses. All three were scaled. All three were well known to the public market investors. They had good visible growth characteristics, and they were profitable. The challenge, and where we think the transactions ended up not performing in the aftermarket, were largely due to technical factors. And what I mean by that is the playbook that was used to execute those IPOs was very defensive. First, the offering sizes were very small, particularly when you look at the amount of stock that's floated relative to market cap. A traditional tech IPO typically sells between 10 and 15% of market cap in the IPO. These, because the market was uncertain, were scaled down to be very small. They were single digits, 5, 6, 7% in total. The second component of being defensive was the utilization of a cornerstone investor. Cornerstone investor is either a strategic investor or a financial investor, where a portion of the offering was pre-sold to those select investors. And they were used in large size. And so when you float only 7% of the IPO and you place up to half of the transaction with cornerstone investors, the amount of stock that's available for public market investors gets very small very quickly. And ultimately, that small amount of stock, when it was placed with the large investors, large mutual funds and multi-strat hedge funds, where they're running very large portfolios, the amount of stock they were given in the IPO was candidly, irrelevant and would have no impact on the fund's performance because it was too small. And therefore, they were not incentivized to be long-term holders and aftermarket buyers. Many of those investors, when the stock opened, sold the stock into the market and moved on and said, we'll come back to these companies when the lockup expires and liquidity improves and we can actually build a meaningful stake in the aftermarket. And so it's our view that that was the primary driver of the poor or lackluster aftermarket trading. What does that mean for the IPO market going forward? I think there were a lot of lessons learned. And I think as we see the next crop of IPOs come to market, cornerstones will still be used, but I think they'll be used in a more moderate size. 10, maybe 15% of total deal size would be placed to cornerstone investors. And number two, I think around deal size, I think we're going to revert back to the traditional 10 to 15% to enable the attraction of the larger investors who value liquidity over sort of the artificial one-day pops that come about from constraining liquidity so much.
Right.
And these really had a chilling effect on companies. We had a number of companies that were, as these were going public, were preparing to go public. And as soon as they played out the way they did, they all kind of put pencils down and said, let's focus on execution. Let's revisit this a year from now. And so we're just now starting to have conversations with them roughly a year later about do they want to revisit it or not. And so it had a major impact on companies' planning and decision making.
It's an interesting follow-up question, which I think one of the things as a lawyer that we've seen over the past few years was a transition to at least consideration of alternatives to IPOs, right? We speak of IPOs, sort of as a catch-all, but in fact, in that last cycle, we saw direct listings. We obviously saw an enormous boom in SPACs. And I think that one of the debates that we have as lawyers is we speculate about, are those trends going to continue? Are we going to see even, perhaps more innovative or novel structures? And, there are other industry participants who, are constantly looking for ways to say, hey, this is a better or more efficient way for us to access capital. Do you guys think we're going to see more or less of that as we move forward?
I think we're going to see a pause.
Yeah.
Right. So as this market heals itself and reopens, I think we're going to go back to basics. We're going to go back to traditional IPOs, again, sized more appropriately to provide the liquidity that the investors really desire. As we sort of work through 24 into 25, I do expect that innovation continues. And it may not be as dramatic as direct listings or SPACs. Even within the traditional IPO process, I think there's areas where companies and their pre-IPO investors want more flexibility and innovation. Think around lockups as an example. And how can we innovate that so that the pre-IPO investors get the liquidity that they're looking for in the context of an IPO, and public market investors also get the liquidity that they want as it relates to trading volumes and ability to buy stock and sell stock freely in the open market, and really trying to smooth the historical 180-day cliff vest, which is a relic of sort of ECM from 25 years ago, and it took a while for it to be innovated on, but it's a win-win because investors, they don't like the 180-day cliff vest, and clearly companies are looking to provide more liquidity options sooner.
Well, and I'm sure you guys remember this, but I think we were one of the three of us, in fact, on a Zillow IPO, were one of the first to really take approach on a phased lockup release like that.
Look, I think in what it highlights is the frustration with the traditional IPO process, and people try direct listings, SPACs, and are trying to be creative. As you said, we tried it 15 years ago and made some novel innovations at the time, and I think it's going to continue to evolve. You've seen, our friends like Bill Gurley and others being aggressive out there about how it needs to change. And look, we're in Silicon Valley. There's innovation all around us, but something something that's so critical hasn't changed in multiple decades. And so we do think there's going to be attempts at changing things, at least around the edges, until there's something that kind of works for everybody. And I'm not sure we've actually found that perfect situation yet.
Right. My personal opinion is I think it is going to be also impacted by that regulatory landscape that we alluded to earlier, which is I think you are seeing the SEC and others who have oversight there become more and more focused on the way in which specifically tech is accessing the capital markets, right? There's a certain amount of skepticism there, and I think we just very recently had a very large rule release from the SEC as it relates to SPACs, and my personal opinion is that's going to have some spillover even into other structures as investor protection continues to take on more prominence.
Yeah, totally agree.
Well, John, Zaheed, want to thank you guys for joining us this morning. It's been a really helpful session, and let's hope 2024 goes well.
Thank you.
Thank you, Jamie.